So in 2026, the Strait of Hormuz effectively closed, which basically choked off like 10 to 14 million barrels of oil a day from the global economy.
Right, a massive, massive amount.
Yeah, and every major economic model, every geopolitical analyst out there, they all predicted this catastrophic price spike, like $200 a barrel.
Because the global supply was essentially being suffocated overnight.
Exactly. But instead of skyrocketing, the price of oil just, well, it crashed.
Yeah, it completely broke the standard macroeconomic playbook. I mean, a supply shock of that magnitude, it really should have triggered instant worldwide panic.
Right. So today, we're breaking down the terrifying reason why it didn't. We're pulling from this really fascinating analysis featured on the Tom Bilyeu YouTube channel.
Yeah, they do a deep dive into global macroeconomic indicators, oil futures, and this massive hidden economic crisis.
Our mission for this deep dive is to figure out what happened to that missing oil demand, like how a huge global superpower might have actually used a Middle Eastern war to hide an internal collapse.
Right, and what this invisible systemic recession actually means for you, your career and your wallet.
Okay, let's unpack this.
So to understand the sheer scale of the anomaly we're looking at, we really have to look closely at the timeline of that missing oil shock.
Because it just doesn't make sense on paper.
Not at all. The sequence of events in 2026 completely contradicts the reality we've accepted for, the last 50 years.
Right, okay, so let's look at the dates. On February 27th, right before the conflict escalates, Brent crude was sitting comfortably at $72 a barrel.
A very normal baseline.
Yeah. But the next morning, the war officially begins. And within days, the Strait of Hormuz is declared closed.
Which is when the fear sets in.
Pure fear, yeah.
Yeah.
So by March 9th, oil spikes to $119. And then by April 30th, it pushes past $126.
Because, 20% of the entire world's oil flows through that specific geographic bottleneck.
Wow, 20%.
Yeah. And the standard economic assumption has always been that energy demand is entirely inelastic.
Right. I mean, it's like oxygen. If the oxygen in a room suddenly gets cut in half, you don't start, negotiating on the price of air.
Exactly. You just pay whatever it takes to keep breathing.
Because the alternative is death. And a modern economy works the exact same way. Factories have to run, transport trucks have to move food, planes have to fly.
And we actually saw the exact opposite of this price crash back in 1973 during the Arab oil embargo.
Right, the historical precedent.
Yeah. Back then, the global market lost roughly 4 million barrels a day.
Okay.
That represented about 7% of the global supply at the time. And because that demand was inelastic, losing just that 7% caused the price of oil to quadruple.
Which is what shoved the U.S. into that brutal recession.
Exactly. So that 1973 shock, that was the blueprint every analyst was using when they were predicting the fallout for 2026.
Except the 2026 supply shock was astronomically worse. Like removing 10 to 14 million barrels a day is, 2 to 3 times the size of the 1973 embargo?
Right. What's fascinating here is that the subsequent price action left economists completely scrambling for explanations.
Because the math fell apart.
Totally. So in mid-June, the U.S. and Iran signed a temporary memorandum of understanding. The strait reopened briefly, and oil prices dropped $17 in just 4 days.
Which makes sense. Supply returns, prices drop.
Right. That part makes perfect sense. But then the ceasefire disintegrated. Tankers came under attack again. The strait was effectively closed down once more, and oil just it barely reacted.
Wait, really? It just ignored a massive war.
Yeah, it crept up 4.4% and then steadily collapsed all the way back to pre-war prices, in the mid-'80s.
Okay, wait. So if the supply of the world's most critical resource is effectively choked off and prices are still dropping back to the baseline, mathematically demand has to be falling off a cliff, right?
Exactly.
Somebody, somewhere, suddenly stopped needing oxygen.
That's it. The math simply stopped working. Initially, analysts floated this theory of buffers.
Like stockpiles.
Yeah. They assumed countries were secretly tapping into massive strategic petroleum reserves or, finding clever pipeline workarounds to bypass the strait.
So they thought the shock was just being absorbed temporarily.
Right. But as the closure stretched on for months and months, those buffers should have been entirely depleted. A delayed price explosion was inevitable.
And it never came, which means we have to look at the other side of the equation.
The demand side.
Yeah, if the world didn't need the oil, we have to ask, who stopped buying? And the source data points this massive, flashing neon arrow directly at the biggest energy consumer on Earth.
China.
Yep.
China.
During this period of intense geopolitical disruption, China accounted for a staggering 74% of the total decline in global crude trade.
74%, that's insane.
It is. Their seaborne crude imports literally plummeted from 11.4 million barrels a day down to about 6.4 million barrels.
So that's a drop of more than 40% in just months. That brings their imports to the lowest level in nearly a decade. Furthermore, Chinese state-owned refiners slashed their processing volume to a record low of 66.3% of their total capacity.
They simply turned off the machines making fuel.
They did.
And geopolitical analysts immediately rushed to frame this as some sort of, strategic masterclass by Beijing, playing 4D chess.
Right. But the source breaks down four main theories that were floating around to explain this sudden halt in buying, and it dismantles every single one of them.
Let's go through those. The first one was the buyer's strike, right? The idea that China, knowing they're the biggest customer in the room, was flexing its economic muscle.
Yeah, refusing to buy in order to force Iran or Russia to drop prices to rock bottom.
Does that hold up?
Well, a buyer's strike sounds logical on paper, but it completely falls apart when we analyze that refining data we just mentioned.
Oh, because of the 66% capacity thing?
Exactly. If Beijing was just playing a waiting game for cheaper crude, they would still need to provide daily fuel to keep their domestic economy running.
Right, you still need gas for the trucks.
The mechanism for a buyer's strike involves running your refineries off your massive strategic stockpiles while you wait for the global market to blink.
But they didn't do that. They shut the refineries down.
Right. You do not voluntarily suffocate your own fuel supply if your underlying economy is healthy and demanding energy.
Okay, so that knocks out theory one. Theory two is the commercial margins argument.
Yeah, this hinges on the fact that the Chinese government strictly caps the price of gasoline for its citizens.
Right, so the theory goes that when global crude spiked to $126, it became too expensive for Chinese refiners to process it into cheap gas. Like they'd be taking a loss on every gallon, so they just stopped buying.
But the timeline completely invalidates that theory. Yes, crude was expensive in April, but as we discussed, prices eventually collapsed all the way back down to the $72 range.
Oh, true. And it's $72 a barrel.
Chinese refiners can process crude and sell it at the capped consumer price while making a massive profit. Yet, even when the crude became cheap again, the buying didn't resume.
So it was never about the profit margins.
Not at all.
Wow. Okay, well, theory three takes a much darker turn. Wargaming for Taiwan.
Right.
The narrative here was that China was using the Middle East conflict as a live-action dress rehearsal. Like, they were intentionally testing how their economy would survive if the U.S. Navy blockaded their energy imports during a future invasion.
But to test that theory, we have to ask how a nation actually behaves during a blockade scenario.
They'd probably ration stuff, right?
Exactly. If you're simulating a cutoff from global energy, you immediately implement strict rationing, and you draw heavily on your strategic reserves to measure exactly how many days your country can survive.
And China didn't do that.
China didn't either. Their strategic reserves were drawn down by less than 2%.
Less than 2%.
Yeah. They weren't rationing a precious, scarce resource. They were just ignoring it.
Okay, I have to admit, I was skeptical when I first heard this part, because the obvious counterargument is the green energy transition.
Right. The EV push.
Yeah, we hear constantly about how fast China is adopting electric vehicles and building solar farms. I just assumed they didn't need the oil anymore because everything is plugging into a grid.
The EV substitution theory is incredibly pervasive, but it confuses a gradual structural shift with a sudden economic cliff.
How so?
Well, an energy transition moves the needle by a few percentage points a year as old infrastructure is phased out. You cannot physically replace 40% of a nation's combustion engines in a single quarter.
Okay, yeah, that makes a ton of sense. You can't just scrap half your country's cars in 3 months.
Plus, the specific type of fuel they stopped using is a massive tell.
Right. If consumer electric vehicles were replacing gas-powered sedans, you would expect gasoline demand to plateau and slowly roll over.
But instead, gasoline and jet fuel demand were actually maintaining modest growth in early 2024. The specific fuel that fell completely off a cliff was diesel.
And diesel is the fuel of physical labor. It powers transport trucks, massive cargo ships, bulldozers, factory generators.
Exactly. You're not pouring concrete for a skyscraper or moving thousands of tons of steel with a fleet of battery-powered heavy machinery just yet.
So when diesel demand evaporates overnight, it points to one specific mechanism. Industrial and construction activity has violently ground to a halt.
That's the real story.
So if Beijing isn't playing geopolitical games, and they aren't wargaming Taiwan, and they haven't magically built a green utopia overnight, what actually caused 40% of their demand to vanish?
The source material reveals it's a catastrophic domestic crisis that they have been desperately trying to hide.
And the timeline is the most revealing part here, because the demand erosion actually began in 2023 and early 2024, long before the first shot was even fired in the Middle East.
Right. The black hole at the center of this mystery is China's property sector.
Oh, wow.
They are experiencing the unraveling of a multi-year real estate bubble that is vaporizing an estimated $18 trillion in household wealth.
18 trillion. That is a number so big it's hard to even conceptualize.
For context, that is equivalent to wiping out an entire year of China's gross domestic product.
And we really have to look at how wealth is structured in China to understand why this is so devastating. Like in the U.S., middle-class wealth is often tied up in a mix of home equity and the stock market, 401ks.
Yes.
But the source notes that property makes up nearly 70% of the average Chinese family's total wealth.
There is a deep cultural and structural reliance on real estate there. For decades, it was viewed as the only guaranteed vehicle for generating wealth and securing a family's future.
So imagine the psychological impact of that. You wake up and 70% of your life savings, the asset you trusted implicitly, is effectively gone.
It's devastating.
The developers are bankrupt, the apartment you bought before it was built is just this concrete skeleton, and the value of your primary home has plummeted.
Yeah. And when that happens, you immediately cancel any plans to buy a new car. You stop buying appliances. You certainly aren't investing in new business ventures.
Economists refer to this specific mechanism as demand destruction.
Sure.
Right.
They do. The closest historical parallel is actually the unraveling of the Japanese real estate and asset bubble back in the early 1990s.
The lost decade.
Exactly. It fundamentally rewrites consumer psychology. When perceived wealth disappears on that massive of a scale, consumption shrinks systemically.
Because everyone just tightens their belts at the exact same time.
Yeah. Fewer consumer goods are shipped, massive construction projects are abandoned, factories scale back their shifts. All of those activities require diesel, and when they stop, the need for oil simply ceases to exist.
But the Chinese Communist Party obviously sees this data. But they don't publicly announce recessions.
No, never.
The source points out a fascinating detail in their latest 5-year plan. For the first time in 30 years, the CCP completely omitted any numeric targets for urban job creation.
Which is unprecedented. They historically promised exactly 55 million new jobs.
And this time, they offered this really vague promise of a, quote, considerable scale, and just vaguely blamed the lack of specifics on the uncertainties of artificial intelligence.
Yeah, blaming AI is a very deliberate misdirection. A foundational rule of global economics is that governments never hide positive economic data.
If the numbers were good, they'd shout them from the rooftops.
Absolutely. Historically, the CCP has used their massive, relentless oil imports as a beacon to signal unstoppable economic health to foreign investors.
Right. As long as the tankers kept arriving, even if Beijing was just quietly pumping that oil into underground storage caverns, the global market believed the Chinese engine was thriving.
They were essentially using their strategic stockpiles to buy an illusion.
Wow. They kept importing oil just to pretend everything was fine.
Yeah, but a country can only hoard so much physical oil before they literally run out of space.
They needed to stop buying, but they couldn't announce to the world that their economy was cratering.
And then, perfectly timed, a massive war breaks out in Iran, shutting down the Strait of Hormuz.
The conflict provided an immaculate cover story.
It did. The geopolitical shock allowed them to abruptly halt their oil imports under the guise of supply chain disruption or high prices.
They could finally align their oil purchases with their newly decimated domestic demand without ever having to confess to the $18 trillion property collapse. And here's where it gets really interesting, because we actually saw Western corporations pull the exact same maneuver recently.
Oh, absolutely.
During the COVID boom, tech companies wildly overhired, like thousands of people. And then they realized they had bloated payrolls just as interest rates rose.
But doing mass layoffs signals weakness to shareholders.
Right. So when the generative AI boom hit, CEOs suddenly had a cover story. They announced they were trimming their workforce due to AI efficiencies.
It allowed them to fix a massive mistake while looking like forward-thinking innovators instead of poor managers.
Beijing used the war in the exact same way, to mask a massive buying halt.
But you know, a vacuum of that size in the East doesn't just stay in the East, it actively drains momentum from the West.
It's contagious.
Very much so. It's really tempting to look at this analysis, point a finger at China, and assume this is a localized real estate crisis. But the global economy is deeply intertwined.
And the exact same symptoms of demand destruction are showing up in the United States.
Yes. The U.S. data is incredibly jarring, especially because the mainstream narrative insists the economy is booming.
It really is. Like in early 2025, the U.S. government quietly revised its job growth numbers. Initial reports claimed a robust 584,000 jobs were created.
And the revision.
The revision dropped that number to just 181,000 for the entire year.
To put that in perspective, adding 181,000 jobs used to be considered a mediocre performance for a single month.
And that was spread across an entire year.
It represents the weakest non-recession labor market since 2003. And when we examine the household surveys from that period, the picture actually gets darker.
Right. Employment was actively shrinking, and labor participation dropped to 61.5%, which is a 50-year low if you exclude the immediate pandemic shock.
You also see this total paralysis in the housing market. The median age for a first-time home buyer hit an absolute record high of 40 years old.
Wow, 40.
Yeah. First-time buyers, who are, the lifeblood of a healthy real estate market, they only make up 21% of all purchases now. That is half of the normal volume we saw prior to 2008.
On top of that, inflation metrics like the Consumer Price Index actually dropped by 0.4% in June of that year.
And that CPI drop is the critical mechanism to understand here.
Because dropping prices is usually a good thing, right?
Usually, yes. But a drop in prices isn't inherently a victory if the underlying cause is toxic.
Right.
That negative print wasn't achieved because the Federal Reserve brilliantly manipulated interest rates to achieve a soft landing. It dropped because consumer demand was stalling out.
The American consumer, much like the Chinese consumer, simply stopped participating in the economy. But this is where I struggle, and I know a lot of people listening, looking at their 401ks, are asking the exact same question.
How are we in a recession if the stock market is up?
Yes. How can we possibly be in a systemic recession when the stock market continues to hit record highs? We look at corporate earnings reports, and the revenues are massive. It feels like a massive disconnect between the macroeconomic data and Wall Street.
That disconnect is what the source material identifies as the phase shift. It is essentially an optical illusion on a corporate balance sheet.
An optical illusion. Walk me through that.
Okay, so during 2021 and 2022, the immense supply chain shocks and massive fiscal stimulus caused the price of almost everything to jump, like 25 to 30%.
Yeah, everything got crazy expensive.
The crucial mechanism here is that while the rate of inflation eventually slowed down, those actual price tags never reversed.
Yeah, the cost of a burger or a car went up 30% and just stayed there. But everyday wages definitely didn't increase by 30% to match it.
Exactly. Now, look at that dynamic from the perspective of a corporate CEO. Because the price of your product permanently shifted 30% higher, your nominal revenue, the raw dollar amount flowing into the register, looks fantastic.
Oh, I see.
But you are achieving those record revenues while selling fewer physical goods.
Because the consumer's exhausted. They're buying fewer items. But the items cost so much more that the total dollar amount hides the drop in volume.
Precisely. You are shrinking the actual footprint of the business while printing more cash. If you're selling fewer units, you don't need to hire more warehouse workers or, expand your logistics network.
You can just quietly cut headcount, dramatically boost your profit margins, and watch your stock price soar based entirely on those nominal revenue figures.
It creates this stunning facade of corporate health, but it is entirely dependent on the consumer's ability to keep absorbing those inflated prices.
And the consumer has been funding that illusion by completely draining the excess savings they built up during the pandemic and aggressively maxing out their credit cards.
But that is a finite resource. Eventually, the credit limits are hit.
And that is the demand destruction we are witnessing now.
Yes. The physical volume of the global economy is contracting. If the stock market is masked by inflation and corporate revenues are an illusion, we really have to look for unmanipulated data to see the truth.
Right, the numbers they can't fake.
Exactly. We have to look at the curves, specifically the oil futures curve and the bond market.
Okay, let's explain how these instruments actually work, starting with the oil futures curve. When massive institutions buy oil on the futures market, They aren't just buying physical barrels for today.
No, they're locking in a price for oil delivered next month and negotiating totally separate prices for oil delivered a year or even 5 years down the line.
Right. And in a standard market environment where a genuine shortage occurs,
Mhm.
like a war shutting down a massive shipping lane, the near-term oil trades at a massive premium.
Which is known as backwardation. Traders are panicking, right? They need physical oil to keep the lights on tomorrow, so they bid the price of immediate delivery to exorbitant heights.
Which we did see, very briefly. In June, near-term oil spiked to $90.
Hmm.
But by July, the panic just evaporated and the entire curve went flat.
And the most telling detail is what the source calls the long tail oil, the contracts priced for delivery years into the future. That oil is anchored firmly down in the 60s.
So they're betting oil will be cheap for years.
That flat curve is the institutional market screaming a warning. The smartest money in the world isn't terrified of a supply shortage. They are terrified that there will be vastly too much oil sitting around.
Because they are actively forecasting a massive, sustained collapse in global economic activity.
Exactly. Even OPEC, the cartel whose sole purpose is to maximize oil profits, they aggressively cut their 2026 demand growth forecast down to just 800,000 barrels a day.
And the bond market is flashing the exact same systemic warning. The break-even rate is sitting at 1.94%.
Think of the bond market like a global betting parlor where the most sophisticated investors on Earth put trillions of dollars on the line. The break-even rate is essentially the crowd's official, mathematically binding bet on what future inflation will be.
It's calculated by finding the difference in yield between a standard U.S. Treasury bond and an inflation-protected bond, right?
Yep. By locking in at 1.94%, the bond market is betting massive amounts of capital that inflation is going to plummet by half within a single year.
Wow.
And again, they are betting this will happen because consumer demand is dying, not because of clever policy.
You know, the source material offers a really crucial piece of advice here regarding political noise. The source points out that, whether you're looking at leaders like Trump or anyone else on the political spectrum, you have to ignore what they say on TV and watch what they actually do.
Right. Look at the actions, not the rhetoric.
Exactly. We're keeping this totally impartial here.
Yeah.
But the data dictates that you ignore the talking points. The political theater is basically designed to distract from the macroeconomic data curves we are discussing today.
That's a great point. If we connect this to the bigger picture, we really have to recalibrate what economic pain actually looks like.
Because when the average person hears the word depression, they instantly visualize the catastrophic stock market crash of 1929.
Right. They picture sudden panic, bank runs, overnight devastation.
We are conditioned to think of a recession as a singular violent event, like a sudden heart attack.
But the actual defining trauma of the Great Depression wasn't just the crash of 1929. The true suffering occurred during the grueling period from 1932 to 1941.
So it was the duration.
Exactly.
Right.
It wasn't characterized by daily market crashes. It was characterized by a suffocating lack of upside. Economic growth simply vanished.
Wages stagnated for years. Job creation flatlined.
And the entire middle class found themselves entirely frozen in place for a decade. The unmanipulated data today is pointing toward a modern version of that exact invisible depression, a slow, agonizing stagnation.
So we've walked through the mechanics of a massive global puzzle today. We've seen how the oil shock that should have broken the economy failed to materialize.
Right.
We explored the mechanics of China's $18 trillion real estate black hole and how they utilized a geopolitical crisis as a convenient cover story.
And we've uncovered how the U.S. economy is masking its own severe demand destruction behind the optical illusion of inflated prices and maxed-out credit cards.
So the most important question remains for the listener. What do you actually do with this information?
Maintaining optionality is the most critical, actionable step here. For the past decade, the prevailing financial strategy was a blind, risk-on assumption of endless growth.
Just throw money at tech and watch it grow.
Right. Investors were rewarded for throwing money at growth stocks and assuming the line would always go up. But the macroeconomic indicators suggest that era is pausing.
The source strongly suggests prioritizing downside protection, specifically by increasing your cash and cash equivalents.
And to be clear, this isn't about panicking and stuffing physical bills into a mattress.
No, definitely not. It is about understanding that when the job market tightens and corporate growth stalls, having liquid capital provides you with choices.
Exactly. When others are forced to take on terrible debt or sell assets at a loss just to survive, cash allows you to weather the storm on your own terms.
It also requires a heavy dose of skepticism regarding near-term technological miracles.
Yes. The current market is putting an enormous amount of hope on artificial intelligence to just, swoop in, solve the productivity crisis, and justify these towering stock valuations.
And while AI will undeniably reshape the long-term future, you really have to ensure your portfolio and your career are resilient enough to survive a prolonged economic hangover.
A hangover that could be measured in years, not months.
The ultimate lesson here is to ignore the flashy headlines. The media cycle is always going to prioritize the immediate panic.
Always. The burning oil tanker, the daily stock ticker, the loud political soundbite.
But the undeniable truth of the global economy is hidden in the boring data. You need to pay attention to the long-tail oil pricing curves. Monitor the actual physical volume of raw materials being imported by massive economies.
Because that is where the genuine health of the world is measured. Data uncovers reality, even when institutions work tirelessly to obscure it.
Right.
When you observe global demand for physical resources collapsing while stock indices celebrate all-time highs, you know you are witnessing a profound disconnect between the underlying economy and the public perception.
Which leaves us with a truly haunting thought to chew on as we wrap up.
Yeah.
We've explored today just how meticulously a narrative can be constructed to hide a terrifying reality. We've seen how Beijing used a literal war in the Middle East as a perfectly timed cover story to mask a catastrophic domestic decline.
And we've seen how American corporations weaponize the AI boom to hide their massive pandemic era overhiring mistakes, quietly shrinking their workforces while keeping their stock prices artificially inflated.
It really forces you to look at the future through a completely different lens. Because as this underlying global demand continues to secretly collapse, and the structural economic pain becomes too massive to hide behind manipulated jobs data, what major global event or what shiny new technological buzzword will governments and corporations use next to mask the next phase of this invisible depression?
It's a sobering thought.
Keep questioning the headlines. Thanks for joining us, and we'll catch you on the next Deep Dive.